In Q3, the combination of interest rate cuts and growing profits provided a positive backdrop for both growth and defensive assets. It ended with strong returns across most major asset classes, despite several spells of market volatility. So starting with the economic review, US GDP growth was still running around 2 to 3% into Q3. Although some leading indicators are starting to show some signs of easing, there is still little evidence that the economy in the US is on the verge of recession. Surveys indicate that economists are actually raising their forecasts for US GDP growth in 2024 towards 2.5%. Over the third quarter, inflation trends remained unchanged in most countries, with a slow deceleration in headline inflation. And whilst unemployment rates have started to increase in most economies, the uptrend remains moderate. One important factor supporting the forecasts of lower inflation is the oil price, which is back around $75 per barrel. This reflects the weakness in the Chinese economy and the lack of action from OPEC on output. And so far, Middle Eastern tensions have not had a major impact. The US Federal Reserve surprised many in the markets by cutting rates by 0.5% to 5% in September, bolstering arguments for a soft landing next year. The looming US election means a further cut before December seems unlikely, however. The European Central Bank also delivered its second rate cut in September, taking interest rates to 3.5%, whilst in the UK, the Monetary Policy Committee is expected to act again in November, after embarking on its own easing cycle with a 25 basis point cut at its August meeting. However, a gradual approach to easing policy is expected against the backdrop of the UK budget on the 30th of October. So moving to growth assets. Now, whilst the Fed's latest rate cut has helped push the major US market to record highs, the composition of the market will need careful attention over the coming weeks. One of our themes this year has been a broadening of returns, and this is starting to play out in the States. Historically, sectors that benefit when rates are coming down are areas which are considered defensive, such as consumer staples or healthcare, and also shares of industries that pay big dividends, like utilities. Turning to regional returns, Asia ex-Japan was the top performing major region, as it rallied strongly towards the end of September after Chinese policymakers announced a package of new stimulus measures. And this gave a positive message to financial markets that the government stands ready to support the Chinese economy and its markets. Looking at factor performance, the value and small cap factors were the standout performers over the third quarter of 2024. With this broadening of returns emerging in the US, this saw the growth and momentum factors make the least headway in comparison. Looking at defensive assets, bond yields were driven by a combination of interest rate cuts in the major economies and expectations of more to come in 2025. The end result has been US, UK and German bond yields are lower than a year ago. Also, positive corporate news has continued to support investment-grade bonds as well. So in summary, recent volatility in stock market shows investors are well aware of just how much rests on a soft economic landing. Positive profits, growth and lower interest rates remain key drivers as we enter the fourth quarter of the year. There will likely be more volatility ahead, with November's US election one of several potential catalysts. Therefore, maintaining a balance between risk and defensive assets remains a sensible strategy, particularly as the correlation between equities and bonds has diverged once again back towards what has been historical norms.